and good evening. This is Mr. W with another TCV video for your pleasure. Hope everybody's doing well and feeling merry going into the holiday season. Certainly is pretty merry in the Bitcoin markets right now, with BTC hanging in about the mid 19.3s after testing 19.5 and pulling back a little bit, but things look pretty good from that perspective. For more information on that, go to TCV, subscribe, and my CMU updates are there 4 days a week, almost every day. So go check that out, and you can get my latest forecasts for Bitcoin, Monero, Ethereum, and Zcash. But the focus of tonight's video is going to be to explain my charts better. So we've been getting some questions about what the heck is going on my charts. And so I just wanted to explain what is happening, and then give people some tips and tricks as far as trading view and maybe a few other things to help out with your trading and analysis. So we'll start with the 3-day chart that we used in today's CMU for the longer term perspective in order to get some targets for the upside if we break out here. And so I'll go ahead and put those on in a little bit and show you how to calculate those on the upside and the downside. And so we figured we'd just stick with this chart, because if you want to watch this video and hear me explain this particular chart, then you can go onto the cryptovigilante.io and check out the update and see, how I interpret that in terms of my forecast and what I think is going to happen going forward. So anyway, we'll go ahead and start with the 3-day chart. And the biggest, most common question that we get from most people is, what are these multicolored rectangles, these blocks that are coming off of these seemingly random levels here on this chart and then up here? And so just to begin, pretty much these are just areas of support and resistance that we think are going to be important. And so the bluish, purplish ones below the market are support, and then any ones that you see above the market in yellow or orange or brown are going to be resistance areas. And these areas originate from what we call supply and demand areas. So where there might be a supply of coins that are available above the market, or or demand for coins at certain key levels below the market. And so essentially, though, these are what are known as institutional order blocks. And order blocks are essentially where bigger players, traders, institutions get active in the market, either on the long or the short side. And so most of these areas are just my own areas that I've picked out just based on years of experience of where institutions are likely to be active, which typically is, if they're going to buy, they want to buy low. And so they would be buying on this down candle right here, or let's say right here, this sell-off. They would set the bottom essentially. And so this is where the institution, is likely to be active. Same thing here. This is actually rejection. And so we'll talk a little bit more about candle formations in a little bit. And so that's kind of just a little tip is, and up here, where would institutions be active? Again, up here, they want to buy low, sell high. And this is a long-term order block right here that goes all the way back to previous highs in 2017. So the supply of coins here are coins that have been underwater for quite a long time, which is why we're seeing some turbulence here in this area. I think there's quite a few people that are happy just to get out at break even around here. They'll regret it, but I think that's what's happening. And so it makes sense that in this, an area we've had marked for a while off the all-time high, that you're getting some consolidation. Now, if you're on TradingView, I just discovered this a couple weeks ago, and this is great for confirmation. This guy that I follow on Twitter, I can't remember what his Twitter name is, Valmo. He made this order block finder that he's been improving, and let's slap it on here and see what it looks like. And boom. So, here we go. Bullish order block here. And this area is actually key of 1, 2, 3 in this $7,000 area. So that was very strong support. And then another block here, another block here. Now we can see the last, this is the tightest order block to the market right now, a longer term time frame. And it's down around 11.3, which is one of the reasons why we've been a little worried about a dip, down to into this region, 11, 12, 14, just because there's not a lot of longer term support. We're high above the moving averages, and we're hitting some trouble here again. So this is just, so again, about the order blocks, this is just confirmation essentially that we have these things in the right spot. And so again, order block finder is what it's called in TradingView. And so that's what those levels are. Those are just key levels. So when you're looking at this and you're looking at the charts that we put in the CMUs, you see those, especially since we're in a lot of coins are in bull trends, longer term bull trends now. Your targets essentially are going to be those areas above the market that are in these yellow, brown, orange rectangles. Essentially, if you're a shorter term trader, that's where you'd be looking to take profits, and you would be looking to add back on support once another one of these demand areas develop, which doesn't happen overnight. But in a bull market like this, they can form pretty quick. And essentially, if this thing starts rocketing, then maybe the order block finder doesn't say it, but we would put a new higher demand area in here in case, of a blow off and then a retest. That's where we would look to get back in. And we'll look at upside targets here in a sec. But so anyway, that's the supply and demand areas / order blocks. Next, we will look at, like I was saying before, a lot of times early in the updates, in the first sentence or two, we'll talk about first of all candle formations and also market structure. Let's start with candle formations, and that's it's somewhat a subjective thing. There's some books about candlesticks. The Japanese art of candlestick charting, I think, is the classic one. But essentially, you're looking at the bodies and the wicks in relation to each other. And so, just a typical bearish candle would be like we talked about on the order block. This candle right here, closes near the lows. Something like this, long body, little wick, down to new lows. That's just a pretty bearish candle. Conversely, these little guys over here, some like this one right here, this one right here, this one right here. So you have a longer kind of bullish body with a little wick. The higher that body goes up into that wick, the more bullish it is. And so that's just kind of a general rule of thumb with those traditional looking candles. And then you also get what might look like a bearish candle at first because you have a bearish body, but this long wick that tells you that price went down here and explored and was quickly rejected back up by the bulls. So this would be a bullish candle. Whereas if we have the opposite, let's say we have a long wick to the upside, let's say like this one right here, even though it's just a near-term move. So we see this candle right here. You had a little body, a spike up that was rejected back to the downside, and then some bearish price action back down in here. And so there's different names for a lot of these things, but that's not really important. Just what's important is what do the wicks look like and what do the bodies look like on the close. And so that's what we're looking at when we're talking about bullish and bearish candle formations. Market structure is another thing that we'll talk about a lot in the updates, which is, so there's kind of two kinds of market structure that we look at. Traditionally, market structure means are we making higher lows, higher highs, or lower lows, lower highs? And so here you can see that this trend right here is the bearish market structure trend. You have a high here, lower low, lower high, lower low, lower high, lower low, low, just slightly higher high. This is almost like a swing failure pattern here, and then boom, and then new lows. Whereas this is where we saw the shift back to bullish market structure. We had a lower low, and then here we had a slightly higher high than this guy. Definitely a higher low than here, over in here. Another higher high, higher low, higher high, higher low. So now we're in a bullish market structure regime. Now, the other kind of quote unquote market structure that we like to talk about, or that we look at or reference, is whether you are making W's or M's. And so essentially, do you want to see in terms of market structure, when a bottom is forming, you want to see this nice kind of rounded structure right here. Lots of time to explore these levels, plenty of time for the bears to get in, and you have some kind of cup, some cup formations here. You can see like this. That's bullish markets. That would be considered bullish market structure. Whereas over here you have the opposite. These rounded kind of tops. Right here. And so this looks like bearish market structure. It is a traditionally bearish market structure regime right here, and also just from a appearance curvature standpoint, bearish. And then you can see again a reversal. This starts to get back into bullish market structure in both terms, in both ways, and then boom, off we go. Now the real move, the real bull market hadn't started until really right here, the breakout above 14K. We had a longer term higher high, but anyway, so yeah, market structure is firmly bearish here. But that's what we're talking about when we talk about market structure. Okay, so next, we'll talk about moving averages pretty much in every section. Here's what those are. These lines, these three lines: 200 SMA here, 100 here, 50 here. Those are just standard moving averages. And these are simple moving averages, not exponential moving averages. Now, a lot of people will use EMAs instead of SMAs, but on a higher time frame, like this 3-day right here, and even on anything above a daily, we will use the SMAs. I just have found over the years that they're a little more accurate. And so that's a preference thing, though. Shorter term time frame traders very well may use EMAs very successfully. So, but anyway, you can get down into the 20, 15 MAs that really tighten up against price and can show you early indications of a trend change. But we also just find that gives too many false signals, especially in a trend market, in a trend like this. So we like to just stick with the longer term trend indicating SMAs, 50, 100, 200. Those tend to do well for us. So that's the moving averages. Let's go to momentum and volume indications. First, Willie, this is a modified Williams, what they call a Williams percent R, which is a momentum oscillator. And so this is something that I found is a little more accurate, a tweak on the Williams, but using the Williams would work fine too. But you can find the Willie on Trading View, CoinG. I'm pretty sure you can find it anywhere on these trading charting platforms. And then let's see, we got RSI, just a classic relative strength index reading. Overbought over 80, oversold under 20. You can see we're just under overbought, but the key is that these oscillators mean different things in different market conditions. So if we were trending, if we were in a trending market like we were all throughout here, all 2020, pretty much all of 2019, then these overbought and oversold readings start to matter a lot more when both of these, kind of get up into this top sector. Now, in a trending market, these things can stay overbought for long periods of time, and a lot of times overbought indicates strength rather than exhaustion like it would otherwise. And so if we look back here to the last bull market, Willie pretty much stayed pinned up in overbought territory, so that wasn't a good indicator in terms of trying to call targets or tops throughout the cycle. And RSI had a few pullbacks, but once the move really started going, it really didn't come back. But you can see that compared to that last cycle, we're pretty overbought here. And so I'm expecting some kind of major pullback before this thing really starts rocketing into a parabolic fashion. But that might not come till higher levels. And so it's looking like the markets wants to go higher, is bullish here. And so overbought is indicating strength rather than fatigue or exhaustion. So I think that means stay long. MACD has corrected back almost all the way back to its zero line, but is holding. That's bullish and is actually likely to start picking up a little bit more now that price is moving back higher again, especially after this candle closes. So MACD could be a little bit worrying, but this is just a moving average convergence divergence indicator. Lots of people use it, which essentially is what are the distances between certain moving averages. Now, not these ones, much shorter term, the 12 and the 26, but that's all it is distance between moving averages and what that can tell us. And what this is telling us is that the MAs have squeezed. They've squeezed down close to each other. But now there's a potential for expansion again, which makes a lot of sense. If we move on to volume indications, accumulation distribution is essentially kind of an OBV, on balance volume type reading, just calculating on average sell volume versus buy volume. And so we can see as we have a rally higher, we have a bearish volume divergence in terms of exchange volumes, but the AD line is signaling that all of this is buying activity, very little selling. Even up in here, like we said, where you could get some selling from back in 2017, 18 up in here, you're really not seeing it in the AD line or in exchange volumes. You're not seeing much selling at all, which is probably why you have this pressure higher. There's just too much demand right now. And so volume indications, overall pretty bullish. So now we want to, if this is our setup right here and we're feeling pretty good about what's going on in here in terms of, higher prices after these kind of rejected sell-offs here, where would we expect things to pop to? And conversely, if we're wrong and this ends up being distribution, the bears are selling here in anticipation of lower prices before new all-time highs, where would we look? Now, first of all, I just put these lines here. This is the 14K high from last summer. This is the 12K high from earlier this year. And this just seems like a reasonable area if we're going to pull back to test what was resistance in this area, pretty heavy resistance for years. And so let's start there. Let's start the less likely scenario is we pull back to 12 to 14K, and let's just see if that lines up with our what we call the OTE, the optimal trade entry zone, which is the 61.8 to 78.6% Fibonacci retracement level. And so, I think so this is the last real swing low down here, and this is the swing high we're dealing with at all-time highs. So let's just pop this fib on here and then go up to this high, and we can adjust all this. So now let's go put my OTE on here. Get rid of these for now. And look at that, boom, lines up right here in the heart in this demand area. 50 MA rising. And it just lines up, and there's a lot of confluence right here, which is one of the reasons we really thought, especially on this second dip here, when it looked like it had a double top coming in, that we just drop down into this area. Great buying opportunity. And so that's it. This, you just drag the fib from here to here, boom, and then you can even go in and get it exact. So this low right here was 98.2507. Go to coordinates. Ooh. 98.2507 up to, what was it, 918.01. We got an exact fib on there. Boom, boom. There you go. 11.9 to 13.6. So that's where those numbers came from in those CMUs a little while back when we were fairly bearish. Still could happen. I mean, nothing is out of the question in this market. So leave some stink bits down here. Be ready to buy anything under 14 if we get it, and fast, because it's not going to last long. So there's your downside fibs. There's your buy fib, 61.8 to 78.6. Now there's also the sweet spot, the 70.5. I don't have it marked here, but a lot of guys will use that too. But it's essentially dead in the middle of this area here. So again, lots of confluence there. Buy that if you get it. So here, let's flip it around now. And this time we want to see what are the extensions off of. Let's see if I have this. I think I might have to go all the way back to 2017. Boom, boom. Yeah, okay. So actually what we're going to do, go ahead and delete this, and then we need to go all the way back here. Okay. Now let's grab the fib. So now this is the top, 19,666. That's it. Boom. So that's going to be the top of the extension zone, and then we want it to come off of the low, the cycle low, which was 31.22.28. 31. Okay, there we go. Now we can extend this out here. Let's get the coordinates going. Coordinates. 1.2228. Boom. Okay, there it is. There we go. There we go. There's our targets. 23.5 to 25,000. There we go. Okay. There we go. That looks all right. So, I mean, if this thing goes, even if we get this pullback, these are likely targets. If we just pop here, which is, I mean, given recent price action, that's what it looks like. We're just going to go, whoop. You know, that's a month from now. You know, so maybe that takes 2 to 4 weeks to play out, depending on how crazy this gets, and given liquidity conditions over the weekend. But 24,000, 24.5. That's right in the sweet spot. That looks really good as far as a target. That also is, so if we take 14 and we go all the way down to this low around 3, so this is an $11,000 move right here. And so you know, we have, let's say, this low up back up to 14.11. If we double that, so if we do what's I mean, kind of like a ABC type move, even though we haven't had much of a correction, but coming out of this, a lot of times price will double on a measured move off out of this range, and that would put us, so 11,000. You know, being this whole range, 11,000 plus 14,000 puts us at 25 right up in here. Again, more confluence. So I'm sure if we look, we could find even more up in here. But, and this is just a shorter term top. This will be where likely we pop, come back down, retest 20, maybe even 18, and then, squiggle around here for a little bit, boom, boom, and then we can really rock it up and start getting into true price exploration mode. And so bullish, for more details, go ahead and check out the TCV CMU from today and yesterday, but today for the targets and how fast we think that'll happen and kind of what happens from there, which we'll get into more later this week in those updates. And so that's where we're getting the fibs from, and that's a key part of it, especially as coins enter these new cycles. We want to see when coins enter price discovery, it gets really hard to determine targets because you don't have any supply and demand activity, any institutional activity, any activity whatsoever, above the market. Hence, price exploration. These coins, Bitcoin's first, is going to have to find new valuation before it can start responding to historical levels again. And so the fibs help with that a lot. But putting all this together is how the analysis is done, and these are just the tools that I use to get it done. And there's some others, that we can talk about down the road that may be a little more advanced or complicated or more idiosyncratic to specific situations and so might not be applicable here. But we can get into those things down the road. But I just wanted to get into some basics about how I put together the charts, what these things mean, and what what the implications are if we use these tools properly. So anyway, hope everybody enjoyed this. We'll expand on this stuff later. I think next time we might do some stuff on exchanges, get into a little more of the nitty gritty on order types and order books and stuff like that for more specific trading strategies. So stay tuned, and again, check out the TCV CMUs. Go ahead and subscribe, and you can get these almost every day of the work week. And so, enjoy the holidays if we don't see you until then. Cheers.